October 31st, 2025, a date that will be remembered as the day the global monetary system began its irreversible split. The International Research Institute for Advanced Systems issued 100 units on the Cardano blockchain, each unit backed by a reserve basket composed of 40% physical gold and 60% BRICS national currencies. Not paper gold, not gold derivatives, physical gold, deliverable, redeemable. And here's what nobody in the Western media is telling you. By December 4th, just 34 days later, market fluctuations had adjusted the value of the reserve basket to 98.23 grams of gold per 100 units. The mechanism is working, the system is live. And on December 8th, 2025, the BRICS Alliance officially confirmed that the unit has launched as a working prototype designed to reroute trillions in trade away from the US dollar. 10 full member nations, 22 additional countries in application stages. 11 full participants already using the system, and here's the number that should terrify Western central banks. 40% gold backing means that for every unit created, physical gold must be purchased, delivered to member countries, and locked into escrow accounts that remain on their own sovereign territory but are removed from their central bank balance sheets and placed onto the Enbridge distributed ledger. This isn't coming. This is happening right now. Andy Schechtman, president of Miles Franklin, stated in July 2025 that the gold will be in the form of kilobars, deliverable and redeemable for member entities, minted in member countries, put into escrow accounts, taken off the ledger, off balance sheets, and held in their own borders. It doesn't need to be sent to a central authority. This is permanent gold removal from the available supply, and it's accelerating. If you want to understand the single biggest threat to Western financial dominance, why gold prices are heading to $5,000 and beyond, and how to position before this system scales to trillions in trade volume, smash that subscribe button right now, hit the notification bell, share this video with everyone who needs to see this, because what I'm about to show you is the mechanism that will remove potentially hundreds of billions of dollars worth of physical gold from global markets permanently. The 40% lock, the unit, the end of dollar hegemony, and it's already operational. What the BRICS unit actually is, the structure. Let me explain exactly what the unit is, how it works, and why it represents the most significant monetary innovation since Bretton Woods collapsed in 1971. The BRICS unit is a gold-anchored digital trade currency designed for cross-border settlement. It's not a consumer currency. You can't buy coffee with it. It's a wholesale settlement instrument for international trade between nations, corporations, and central banks. The prototype uses a 40% gold and 60% BRICS currency basket that adjusts daily based on market fluctuations. The 60% currency component is split into 5 equal weights of 12% each: 12% Brazilian real, 12% Chinese yuan, 12% Indian rupee, 12% Russian ruble, 12% South African rand. These currencies represent the original BRICS core with the most developed financial markets, deeper liquidity, larger economies, and more stable currency infrastructures. The role of gold is critical. Gold serves as the numeraire, the unit of account that stabilizes valuation during periods of currency volatility. When one of the component currencies weakens against gold, the unit's value remains anchored because 40% is always physical metal. All deposits and daily pricing updates run on a permissioned blockchain maintained by Irius on the Cardano network. This isn't some fly-by-night cryptocurrency. This is institutional-grade distributed ledger technology designed for central bank settlement. In the initial test launched October 31st, 2025, 1 unit was pegged to 1 gram of gold. That means the initial basket contained 40 grams of physical gold per 100 units. But by December 4th, market fluctuations had adjusted the value to 98.23 grams of gold per 100 units, effectively bringing each unit's value to 0.9823 grams of gold per unit. Think about what that adjustment means. The system automatically rebalances daily. When BRICS currencies appreciate against gold, less currency weight is needed to maintain value. When currencies depreciate, more gold weight anchors the value. This creates a counter-cyclical stabilization mechanism that no pure fiat currency possesses. And here's the critical detail that Western analysts are missing. The gold backing is not fractional reserve. It's not paper claims. Andy Schechtman explained it perfectly. The gold will be in the form of kilobars, deliverable and redeemable. The basket of gold and currencies will be minted in the member countries, put into an escrow account taken off their balance sheet, and put onto the Enbridge ledger, held in an escrow account in their own borders. This is full reserve gold backing held in sovereign territory. Not in London, not in New York, in Beijing, in Moscow, in New Delhi, in Johannesburg, in Brasilia, physical gold that cannot be frozen, sanctioned, or confiscated by Western powers. The M-Bridge connection. The infrastructure is ready. Now let me show you why this isn't just a pilot project. The infrastructure for scaling the unit to trillions in trade volume already exists. It's called Project M-Bridge, a cross-border payment system developed by the Bank for International Settlements Innovation Hub in collaboration with the central banks of China, Hong Kong, Thailand, and the United Arab Emirates. M-Bridge uses distributed ledger technology to enable instant settlement of cross-border transactions in multiple currencies without intermediaries. No SWIFT, no correspondent banks, no US dollar as the middleman, direct bilateral settlement in real time. Andy Schechtman connected the dots. The unit will be backed 40% by gold and 60% by local currencies in the BRICS Union. That gold will be deliverable, redeemable, in kilobars, minted in member countries, and put into escrow accounts on the M-Bridge ledger. M-Bridge is the plumbing. The unit is the settlement instrument that runs through that plumbing, and M-Bridge is already operational. On October 31, 2024, exactly 1 year before the unit pilot launched, the BIS announced that M-Bridge had moved from pilot to minimum viable product stage. Real transactions, real central banks, real money moving across borders without touching the dollar system. Russia formally joined M-Bridge in 2024. Iran is integrating. The United Arab Emirates, already a M-Bridge founding member, joined BRICS in 2024. The pieces are connecting, and here's why this matters for gold. Every transaction settled through the unit backed by M-Bridge requires that 40% of the settlement value exists as physical gold in escrow. If Brazil sells $10 million worth of soybeans to China and settlement occurs in units, $4 million worth of physical gold must back that transaction. Multiply that across billions in daily trade, then trillions annually. The gold demand is staggering. And it's not investment demand that can be satisfied with paper claims or turned off when prices rise. This is structural, permanent, institutional gold demand built into the monetary architecture of a parallel financial system serving 10 BRICS members plus 22 applicant countries representing over 40% of global population and over 32% of global GDP as of 2024. This is demand that removes gold from Western markets and locks it into Eastern escrow accounts permanently. Why BRICS members want this? The motivation. Let me show you why BRICS nations are so committed to making this work. It's not ideology, it's self-preservation. The motivations are economic, geopolitical, and existential. First, sanctions vulnerability. Russia has faced the most comprehensive sanctions regime in modern history since February 2022. $250 billion worth of Russian assets frozen in the European Union. Prohibited transactions with Russia's central bank and finance ministry. Complete exclusion from SWIFT for major Russian banks. Venezuela, Iran, North Korea. China faces the constant threat of secondary sanctions. Even India, nominally a Western partner, faces pressure over Russian oil purchases. When your national reserves can be frozen by executive order, when your banks can be cut off from the global payment system by political decision, you need an alternative. The unit provides that alternative. Second, dollar liquidity traps. Emerging markets borrow in dollars. When the Federal Reserve raises interest rates to fight U.S. domestic inflation, dollar funding costs spike globally. Capital flees emerging markets. Currencies collapse. Debt becomes unpayable. This happened in the 1980s Latin American debt crisis, in the 1997 Asian financial crisis, in the 2013 taper tantrum, in the 2018 emerging market rout. BRICS nations have experienced this cycle repeatedly. The unit allows them to settle trade in an instrument that isn't controlled by U.S. monetary policy. When the Fed hikes rates, the unit's gold component provides countercyclical stability. Third, trade imbalance problems. Russia and China now settle almost all their bilateral trade using yuan and rubles. But India runs a $60 billion trade deficit with Russia thanks to oil imports. Using national currencies becomes difficult when trade flows are imbalanced. The country running the deficit accumulates the surplus country's currency and has limited options for what to do with it. The unit solves this problem. The gold component provides a universally acceptable store of value. India can accept units for exports to China. Those units contain gold that India can redeem or hold as reserves. No need to accumulate yuan or rubles. The gold anchor balances the system. And fourth, long-term de-dollarization strategy. The U.S. dollar's share of global foreign exchange reserves has declined from 65.3% in 2016 to approximately 59 to 60% by the end of 2024. That's a 5 percentage point decline in 8 years. The trajectory is clear and consistent. BRICS nations want to accelerate this trend, not because they hate America, Because they want monetary sovereignty. As Brazil's international affairs advisor Celso Amorim stated, many wonder if the US dollar will disappear. No one plans to do that. The United States is a big country whose economy remains crucial for the entire world. However, an alternative still needs to exist. That alternative is the unit. The gold demand shock. Calculating the impact. Now let me show you what this means for gold markets. The numbers are staggering. BRICS nations collectively represent over 40% of global population and approximately 32% of world GDP as of 2024. Total trade among BRICS members is estimated at $1.3 to $1.5 trillion annually. If even 20% of that trade shifts to unit settlement in 2026, that's $260 to $300 billion in annual transactions. At 40% gold backing, that requires $104 to $120 billion worth of physical gold to be purchased and locked into escrow annually. At $4,000 per ounce, that's approximately 810,000 to 935,000 troy ounces, or roughly 25 to 29 metric tons of gold per year just to back existing intra-BRICS trade. But here's where it accelerates. 22 additional countries are in application stages to join BRICS. If approved, and several are likely to be accepted at the 2026 BRICS summit in Russia, the expanded bloc would control over 50% of global population and approach 40% of global GDP. Trade volumes would explode, and every transaction settled in units requires 40% physical gold backing. According to the World Trade Organization, global merchandise trade totaled approximately $25 trillion in 2024. If BRICS Plus reaches 40% of global GDP and conducts trade proportionally, that's $10 trillion in annual trade volume. If just 10% of that shifts to unit settlement, that's $1 trillion in transactions requiring $400 billion in physical gold backing. At $4,000 per ounce, that's approximately 3.1 million troy ounces, or 96 metric tons annually, and that's a conservative scenario. What if unit adoption accelerates? What if non-aligned countries, the global South nations tired of dollar volatility and sanctions threats, start requesting unit settlement for trade with BRICS members? Andy Schechtman noted that several countries in Africa are watching developments closely. Latin America, Southeast Asia, the Middle East, all regions with strong economic ties to China, Russia, and India. If unit settlement reaches 20% of BRICS plus trade, gold demand doubles to 192 metric tons annually. At 30% adoption, 288 metric tons. And remember, this is structural demand. This gold doesn't come back to market. It sits in escrow accounts on the bridge ledger backing outstanding units. As long as those units circulate, the gold remains locked. The only way gold returns to market is if units are redeemed and destroyed. But why would anyone redeem? Units provide instant settlement, sanctions immunity, and gold stability. The incentive is to accumulate units, not redeem them. In the next part, I'll show you why Western central banks are panicking behind closed doors. The gold supply crisis this creates when annual mine production is only 3,500 metric tons, and central bank demand already hit 1,037 metric tons in 2023. The evidence that China has been stockpiling gold in preparation for exactly this moment. The implications for gold prices when the 40% lock removes hundreds of tons from available supply annually. And most importantly, how individual investors should position as the largest monetary shift since 1971 unfolds in real time. Because here's what you need to understand. The unit isn't a proposal. It's not a concept. It's operational. October 31st, 2025, the first 100 units were issued. December 8th, 2025, BRICS officially confirmed the unit has launched. December 2025, BRICS nations continue buying gold at record pace. 14 consecutive months of purchases for China through December 2025. Russia accumulating despite sanctions. India building reserves. The timing is not coincidence. They're building the gold reserves necessary to scale the unit from billions to trillions in settlement volume. The infrastructure is ready. M-Bridge is operational. The motivation is clear. Sanctions vulnerability, dollar liquidity traps, trade imbalance solutions, de-dollarization strategy. The demand calculation is mathematical. Even conservative scenarios show hundreds of metric tons of annual gold demand just to back unit settlements. And the gold that enters the system doesn't come back. 40% lock, permanent removal from Western markets, locked in Eastern escrow accounts, backing a parallel financial system that's growing exponentially. Make sure you're subscribed, hit that notification bell, share this with everyone who needs to understand what's happening, because the Western media isn't covering this story, they're dismissing it as noise. Fisher Investments called it phony baloney. They said BRICS countries aren't politically aligned, can't coordinate, still need to trade with America. They're missing the point entirely. The unit doesn't need to replace the dollar overnight. It just needs to provide an alternative for countries that want one. And tens of billions in trade are already flowing through systems that bypass the dollar. Russia-China trade in yuan and rubles. Nearly 100% of bilateral trade. BRICS members settling in national currencies across multiple corridors. The unit makes that system scalable, stable, and gold-backed. The 40% lock is the mechanism. The M-bridge ledger is the infrastructure. The geopolitical fracture is the catalyst. And gold is the asset that gets removed from Western control permanently. The wealth transfer has begun. The question is whether you understand it before it's complete. China's gold accumulation, building the war chest. Let me show you the evidence that China has been preparing for exactly this moment. The numbers are staggering. China's People's Bank of China has increased its gold reserves for the 14th consecutive month in December 2025, reaching 74.15 million fine troy ounces, approximately 2,306 tons by month end. The value of these reserves surged to $319.45 billion, reflecting both quantity increases and record high gold prices. The PBOC added about 30,000 troy ounces in December, a modest but steady increment that extended the buying cycle which began in November 2024. This brings total acquisitions during the streak to roughly 1.35 million ounces, or 42 tons. But here's what Western media consistently misses. The official numbers dramatically understate reality. Independent analysis by Jan Nieuwenhuis at Money Metals suggests China's actual monetary gold reserves stand at 5,411 tons in Q3 2025 versus 2,304 tons officially reported by the central bank to the IMF. That's more than double the disclosed amount. In the third quarter of 2025, the PBOC's gold purchases, reported and unreported, accounted for 118 tons, up 39% month over month and 55% year over year, according to Nieuwenhuis's methodology. His methodology is now being copied by Goldman Sachs, Bloomberg MarketWatch, The Washington Post, Time Magazine, Financial Times, Financiële Dagblad, and El País. Why? Because his estimates have proven accurate over time while official Chinese data has proven incomplete. Think about what this means. If China actually holds 5,411 tons versus 2,306 tons reported, that's 3,105 tons of undisclosed gold. At $4,500 per ounce, that's $446 billion in hidden gold reserves. Why hide it? Because announcing massive gold accumulation would drive prices higher before they finish accumulating. It's the same strategy China used with rare earth minerals. Accumulate quietly, establish dominance, then reveal control after positioning is complete. And the timing of this accumulation is not coincidental. The unit pilot launched October 31st, 2025. China's 14th consecutive month of buying ended December 2025. They've been building the gold reserves necessary to back unit settlements at scale. The infrastructure is ready, the gold is acquired, the system is operational. Global central bank panic, the supply squeeze. Now let me show you why Western central banks are panicking behind closed doors. Global gold demand hit 1,313 tons in the third quarter of 2025, the strongest quarterly total on record according to the World Gold Council. This surge was driven by strong investment demand, including purchases via exchange-traded funds, bars, and coins, as well as significant buying by central banks. Total gold demand, including OTC, grew 3% year over year to 1,313 tons. Yet this was eclipsed by the value measure of demand, which jumped 44% year over year to a record of $146 billion in Q3. Central bank buying remained elevated at 220 tons in Q3, 28% up on the prior quarter. Year-to-date, buying through Q3 totaled 634 tons. And through November 2025, central bank net purchases totaled 297 tons, with emerging market central banks continuing their significant gold buying this year, according to World Gold Council data. Poland bought 12 tons in November alone, lifting its gold reserves to 543 tons, or almost 28% of total reserves at end November prices. Since 2022, central banks have purchased over 1,000 tons of gold annually, roughly twice the decade-long average. Emerging economies, notably China, Turkey, Poland, and India, are leading this trend, signaling a long-term diversification away from the US dollar. Central banks bought a combined 1,045 tons in 2024, accounting for about a fifth of overall demand. Poland, India, and Turkey were the largest buyers. Think about the mathematics here. Global mine production is approximately 977 tons per quarter according to Q3 2025 data. That's 3,908 tons annually. Central banks alone are absorbing over 1,000 tons per year. That's 26% of mine supply going directly to central banks. And that's just the reported buying. If China is buying an additional 118 tons per quarter unreported, as Neuenhuis estimates, that's 472 tons annually. Add that to the 1,045 tons reported, and central banks are actually absorbing 1,517 tons annually. That's 39% of global mine production, before any investment demand, before any jewelry demand, before any industrial demand. Nearly 40% of all newly mined gold is going to central banks and not coming back to market. Now add the units demand on top of that. If BRICS trade settlement reaches even conservative volumes, as we calculated in Part 1, that requires an additional 96 to 288 tons annually to back unit settlements at various adoption rates. Where does that gold come from? Annual mine production, 3,908 tons. Central banks absorbing 1,517 tons. The unit requiring 96 to 288 tons. That's 1,613 to 1,805 tons of structural demand, 41 to 46% of all mine supply locked away permanently before markets even see it. And recycled gold supply, which typically adds around 344 tons per quarter or 1,376 tons annually, isn't increasing. Recycling activity was restrained to some degree by expectations of further price gains, according to the World Gold Council. People aren't selling at $4,500 per ounce because they expect $5,000. The supply squeeze is mathematical. The Western panic, why they can't compete. Here's why Western central banks are terrified. The West comprises the US, UK, Western Europe, and Australia. Due to the actions of the PBOC and increasing prices, monetary gold now accounts for almost 28% of global international reserves. This is a truly monumental increase from 21% in 2024, according to Jan Nieuwenhuis's analysis. Because gold has appreciated against all reserve currencies since Q3, gold's live share of reserves is actually closer to 30%. In a historical shift, Eastern countries that before 2022 were price-sensitive are now driving gold higher. By Q3 2025, estimated total of central banks' monetary gold reserves accounted for 40,225 tons, 49% of which is owned by countries outside the West. In the 1990s, this percentage was 25%. Think about what that reversal means. In 30 years, the balance of global monetary gold has shifted from 75% West, 25% East, to 51% West, 49% East. And the trend is accelerating. Poland just announced plans to boost its gold reserves to at least 100 tons by 2030, according to Serbian President Aleksandar Vučić. This long-term target represents a near doubling of current holdings, which stood at 52 tons at the end of October. Madagascar and South Korea also signaled interest in increasing their gold reserves at the recent LBMA conference in Kyoto. The National Bank of Serbia plans to reach 100 tons by 2030. Bulgaria added 2 tons in August, the largest monthly increase since June 1997. World Gold Council research indicates extraordinary institutional confidence, with 95% of surveyed central banks expecting global gold reserves to increase over the next 12 months. This isn't speculation. This is consensus among the institutions that actually manage hundreds of billions in reserves. They see what's coming. They understand the unit creates permanent structural gold demand. They understand that BRICS nations are building an alternative monetary system, and they're racing to position before gold becomes unavailable at any price. But Western central banks face a problem. They can't buy at the same pace without admitting the dollar system is failing. When Poland or Turkey or India buys gold, markets interpret it as diversification. When the Federal Reserve or European Central Bank starts aggressively buying gold, markets interpret it as panic. It signals lack of confidence in their own currency. So Western central banks are trapped. They need gold to maintain credibility as BRICS builds an alternative system, but buying gold at scale signals that their fiat currencies are losing reserve status. It's a catch-22. Meanwhile, Eastern central banks face no such constraint. They openly state they're diversifying away from dollar dependence, they buy gold aggressively, and the unit gives them a mechanism to use that gold as monetary infrastructure for international trade.